back to the Capital Mindset Show. We're doing another subscriber request. This one is one of the other firearm companies. So we already did Smith & Wesson. And for those of you who haven't seen that video, the conclusion for the most part was the company, it was very easy for individuals to do what, let's be blunt about it, noob tier investment analysis and think that it was a buy. There are some popular channels out there that did such noob tier analysis, and I guess their whatever they utilize, their tools, did not quite catch the nuances that we preach on this channel that you have to be careful about. So hopefully in this analysis, we actually go over some of those, because this is actually their peer, their competitor, and this is Ruger, okay? So a little bit of context about Ruger and about Smith & Wesson. These are very difficult businesses. If you're dealing with consumer firearms, they're not a high margin business that, for example, the military defense would be. So you really actually want to sell guns to the military. That's where the real money is. While you still can be successful in civilian firearm sales, it's more difficult. And there is always the legislative backdrop or legislative risk that you have to contend with. And so that's something to be aware of before we get into this, okay? So for the most part, this is going to first cover the, let's talk about the price action and see what's going on, because that might have something to do with why it was requested. So for the most part, we do see a drop from about October. And remember, that's kind of coinciding with everything else. But what I want to highlight, and I have both of them here, is Smith & Wesson actually fell from the time the video was released on Smith & Wesson. So the Smith & Wesson video was released when it was around 17 something, and it's fallen, so about 10% down. I do think there's further pain ahead for this company, but this is not a video on Smith & Wesson, so let's focus on Ruger. But I wanted to show this. On a max scale, Smith & Wesson, sure, it's done okay, right? It's done 1,000 since inception, but it's kind of very volatile. We take a look at something like Ruger, and we see Ruger has been a little bit more up and to the right. You had this up over here. We can't actually call this the same because they weren't public. So when did Smith & Wesson start? All right, 1998. So we can go to Ruger. Ruger, 1998. So about there. Yeah, it's been actually good. Okay, so I actually I think I stand corrected. Do I stand corrected? Yes, I do. 16 bucks. Oh, because it started at what, 4 cents? Really? All right, stand corrected. If these numbers are true, Smith & Wesson is far superior in terms of total returns historically. However, I do see that there has been less volatility as of late. You have basically this huge drop right before. So there was something going on, and we kind of covered that in that video. But today we're going to be focusing on Ruger. And with Ruger, let's actually discuss, I guess, first the key ratios. So taking a look at the key ratios, they look really good. The liquidity ratios look really good on point. The cash ratio is able to cover their current liabilities because they don't have any debt. And by the way, I actually forgot to cover this in the Smith & Wesson video. The reason why they don't have debt is not out of choice, by the way. It's very difficult for these companies to actually loan out money or get loans, right? Not loan out, but get loans, okay? And that's because of the industry that they're in. It's similar to the cannabis industry, right? So the cannabis industry is unable to easily get access to certain types of capital, and the firearm industry is basically the same way. All right, I want to highlight some things to you, and that is the gross profit margins, right? They're pretty good, right? But I do expect them to come back down to normal levels. The ones that are more concerning are the net profit margins. They seem to be double to what they normally are. I do expect that to drop. And that's something that you have to think about. So right now, it's definitely going to look really cheap because they're keeping more dollars for each source of revenue that's coming in. They're basically keeping more of it, right? But as things get back to normal, will that remain? Will that stay the same? I highly doubt that. I think they're going to struggle to really do that, but that's kind of like a wait and see. Okay. Now, taking a look down here, let's take a look at the earnings quality. Earnings quality seems to be on point. It's above 1. That's how we kind of read that score. And then we look at the book value a little bit. Okay. So I don't really care too much, but the book value, it's rising. So that's indicative of something good going on with the business. Again, this is very well capitalized. No concerns on bankruptcy anytime soon. But yeah, let's go take a look at the activity ratios because they do deal in inventory. And yeah, we see that they're kind of down quite a bit. And we're taking a look at it, they're almost down 30% from where they usually are. So I do expect that to return to normal. And I'm looking at the cash conversion cycle here. So yeah, this is basically what my brain's kind of getting from the model. And then let's go ahead and go over to the summary report, and let's not normalize the cash flows. Let's assume the cash flows remain where they are. This is kind of what I would call the more noob tier analysis of this company. And we assume the discount rate. So let's actually put in the ticker RGR. Okay, so analysts have a buy rating, price target of 84, 29.3% implied upside. And these are the growth rates implied. Let's discount it at 20%. Obviously, it's going to look super cheap. Let's put the growth rate down at, well, actually, if it's 10% is the high point, we already can't buy at this level. And they've actually been diluting. So let's actually assume some dilution to make it okay. Oh, double percent. Of course, it's going to get confused. And let's actually lower our discount rate. Normally don't like to do this, but at 15% discount rate, we can be okay. Let's assume a 4%. So 4%, we're not there. They've averaged, let's say 5%, 5%, we're not there. Let's see, 6%, 6% doesn't work. We're going up the percentages, 7%. So 7% and above is what they'd have to grow the cash flows in order for me to achieve a 15% required rate of return. And I haven't normalized the cash flows yet. Not good. All right. So let's go to, well, I'm going to pause here actually, and then I'll have the adjustments and then we'll talk about them. All right. So now everything's kind of normalized. And actually, let me make sure everyone can see better. So zoom in here. So now we're normalized the cash flows, and we're kind of predicting that they will return back to normal over time. And from what we can see here, it's not looking too good, right? So if I think this business is going to get kind of back to normal, I'd have to assume probably a tremendous amount of growth, far beyond what they've done in the past. And basically the price has to come down quite significantly for me to think that I should even include this in my portfolio. And so let's take a look at if they've ever been down there. And let's see, so about $42 a share was where they were in 2019. Now the model with current numbers does believe that I can assume around 7% growth rate, which is still kind of high, but you know, it's within the realm of possibility that they could if they succeed a little bit, right? So let's assume, for example, 14. So 14, I can assume, for example, 6% if they ever got down to that. And I'm pointing out that price because they did revisit that here. So they might come back down at some point. And let's see, yeah, they have dips here and there. But for the most part, I think that the current price is not reflecting the overall risks in the industry. And in this channel, I try to hunt down companies that are going to give us an excess rate of return above the market with a decent margin of safety and quality companies. This may be a quality company, no doubt about that. But is it the right price, right? So I'm not saying it's a bad company. And it's not my cup of tea, just simply because of the risk backdrop. But the risk backdrop, we can discount that away, right? We can get it at a good price or a great price, and then we can kind of work with that, right? But basically, at right now at these prices, I'm having a hard time justifying adding it to the portfolio. So this is as far as I would go with this. Of course, I could be just a complete moron, okay? And then you guys can, you know, look at the analysts and see, oh, the analysts say it's a buy with a price target of 84, implying 29.3% upside, right? The analysts know what they're doing. They're infallible, as we like to say on Capital Mindset. And there you go, right? That's basically it. So on that note, guys, oh, before we leave, I wanted to point something out. I almost forgot to point this out. So everyone take a look at the PE of 7.6. This is what people do. Some people go, oh, PE of 7.6, boom, super cheap, right? So if I, for example, were to readjust the free cash flow numbers, or let's take a look at the key ratios here. Let me show you. So price to free cash flow in the past, it's about 14, right? So they were about the same price. So price to free cash flow at the price around here was 14. And you take a look at the I didn't adjust the PE. So the GAAP net income is about the same. So that's basically what I'm saying is it's really high. Okay. sorry, really low, but the earnings are really high, right? So it's misleading. It looks very cheap, but it's not really cheap on a cash flow basis. On a GAAP net income, sure it is. But there's some accounting metrics, or not accounting metrics, accounting shenanigans that are going on that if you don't understand and you're not careful, will completely mess you up. And basically what I'm trying to say is, bluntly, this looks like it's a value trap, just like Smith & Wesson is, right? I can overtly say that I personally believe, my personal opinion, that Smith & Wesson most likely is a value trap. And then Ruger might fall along that as well. It looks cheap, but you got to be careful. Okay. On that note, guys, if you guys have any other requests, go ahead and leave them down in the comment section below. I'm trying to do more requests more frequently, just so I can get through everyone's requests. And then also maintain quality, though, because I don't want to just snip through and not, just not understand a business and do what we call, nothing against boomers, but it's just a phrase that kind of caught on from Austin, boomer tier analysis, right? So we're not going to be like, I'm not going to say who, but anyway, on that note, guys, have a good one. Bye.